The Irish banking crisis of 2008 was marked by fraud, incompetence, and greed. And when you look beneath the surface, an even darker reality starts to emerge. At the time, there were 6 domestic Irish banks. While all 6 would find themselves in hot water during the crisis, the worst of the bunch by far was Anglo Irish Bank. Led by Sean Fitzpatrick and later by David Drum, Anglo was Ireland's fastest growing and 3rd largest bank. At its peak, Anglo's business was valued at €13 billion, and in 2007 alone, it generated a profit of €1.2 billion. The bank controlled over 18% of the Irish lending market and grew its loan book at an average annual rate of 36%, unheard of in the banking sector. There were 3 secrets behind Anglo's initial success, and it will be these very same secrets that would eventually lead to the bank's demise. The first of which was wholesale funding. Unlike traditional banking, which relies on customer deposits to make loans, Anglo funded the vast majority of its lending operations by borrowing money on the international financial markets. This allowed Anglo to access much more cash than what would have otherwise been available using core deposits. That in turn fed into the second secret, which was credit expansion. Anglo used this abundance of cheap money to significantly increase its lending activity. As a result, the bank's share of customer loans in Ireland grew by 800% between 2000 and 2008. But Anglo wasn't just lending to any old customer. No, it was primarily lending to property developers, and that was the third secret. Over 70% of the bank's lending activity was concentrated in construction and commercial real estate. This combination of wholesale funding, rapid credit growth, and property-focused lending was so effective for Anglo that the other Irish banks would later copy them in order to get in on the action. However, the weaknesses in both Anglo's business model and the Irish banking sector as a whole were exposed with the collapse of Lehman Brothers in the US in 2008. This collapse had a pronounced effect on the availability of wholesale funding, a key ingredient to the newfound success of Irish banks. Without this funding, the banks couldn't meet their obligations to depositors and creditors as they fell due. As a result, Irish banks had resorted to borrowing an unprecedented €85 billion from the European Central Bank by June 2009 in order to shore up their funding requirements. But the shortage of funding was the least of their concerns. Residential and commercial property prices in Ireland had been declining for more than 18 and 9 months respectively prior to the collapse of Lehman Brothers. The market was seriously overvalued, and that was problematic for the banks. If property prices were to collapse, many of the bank's borrowers, especially those who borrowed at the top of the market, would find themselves in negative equity, where the value of the loan collateral is less than the loan outstanding. That in turn could lead to loan defaults, especially among property developers, which, if occurring on a large enough scale, could threaten bank solvency. The worldwide downturn triggered by Lehman prompted a sharp correction in Irish property prices, declining by 9.1% and 18.5% in 08 and 09 respectively. What's more, the recession which followed was marked by a large spike in unemployment and austerity measures that were imposed to manage the country's growing deficit, neither of which were positive for the repayment capacity of the bank's borrowers. Over the next 5 years, the average ratio of non-performing loans for Irish banks would reach 32% or €85 billion. Default rates for SME loans, commercial property loans, and residential loans would reach 26, 70, and 12.9% respectively. None of the banks would have enough capital in reserves to withstand these losses without government intervention, and so the Irish state would provide a €64 billion rescue package, over half of which would never be recovered. It's only when you ask yourself the question, how could this be allowed to happen, that the dark realities of the Irish banking crisis come to the fore. In their quest for market share, the lending practices of Irish banks became increasingly irresponsible in 3 main ways. Firstly, there was the reliance on wholesale funding. While this was the key ingredient that allowed Irish banks like Anglo to grow at such a fast rate, there seems to have been little regard for what would happen if that funding was to dry up. By 2008, loan to deposit ratios ranged between 130 and 140% and 175% for 5 of the 6 Irish banks, and were as high as 280% for Irish Life and Permanent. This means that all of the Irish banks were lending out more money than they were receiving in customer deposits, a highly risky funding strategy. Secondly, there was the reliance on property-related lending. Between 03 and 08, the combined exposure of Ireland's three largest banks to construction and property firms grew almost fivefold. About half of Anglo's total loan book was attributable to just 20 large developers. None of the banks seemed to have an issue with the high degree of concentration risk that existed within their loan books. With the benefit of hindsight, it's glaringly obvious that if the property market was to experience a shock like it did in 08, then the banks would be in serious trouble. Lastly, the overall quality of loans granted by the banks deteriorated significantly. Despite Ireland's largest banks having complex risk management software, this was largely for show, given that numerous exceptions were made in order to grant loans that were in direct contravention to the bank's lending policies, all in the name of protecting market share. In fact, at one Irish bank in the mid-2000s, 35% of property development loans approved represented exceptions to the bank's lending policy. All that mattered was growing the loan book. There were many instances of incomplete and inaccurate data collection, inadequate due diligence, non-conservative valuations for collateral, and overall poor loan documentation. That's before you consider the fact that all of the banks reduced their lending standards by offering risky loan products to both property developers and home buyers. All of this was happening under the watch of a financial regulator who was described as being the worst financial regulator the world has ever seen. Regulation of Irish banks at the time was non-existent, and this is perhaps one of the more shocking realities of the Irish banking crisis. The regulator operated what's known as a principles-based regulatory framework, whereby desired regulatory outcomes were set out in principle, and the banks were entrusted with developing their own business models around those outcomes. In other words, the banks were left to do what they pleased and were never second-guessed by the regulator. However, as the chief executive of the FSA once said, a principles-based approach doesn't work with people who have no principles. The regulator could have taken action to restrict the irresponsible behavior of the banks, limits on property-related lending, higher capital requirements for speculative loans, limits on loan-to-deposit ratios, and a prohibition on risky loan products. But none of this was done to any meaningful extent, and frankly, it's not hard to see why. Firstly, staffing at the regulator was atrocious. In 2005, there were a total of 5 people responsible for the oversight of AIB, Bank of Ireland, Anglo Irish Bank, and Irish Life and Permanent in total. That level of staffing reflected the fact that A, the regulator had zero intentions of implementing any kind of intrusive or challenging regulatory approach, and B, that there were plenty of high salary jobs available elsewhere in the financial sector. Even if the regulator wanted to implement a new approach, the individuals who made up the board lacked the skills and quantitative ability to do so. Secondly, and arguably most importantly, within the regulator, herd behavior and groupthink affected both staff and managers, where they were expected to adopt and conform to consensus views. Departures from such views were portrayed as going against team values, and any rocking of the boat was frowned upon or at a minimum discouraged. Put simply, the regulator didn't want to introduce any changes that could spoil the party. Even in the face of major red flags, the regulator did nothing. Both the run on Northern Rock in the UK in 07 and the near collapse of Bear Stearns in 08 had significant negative effects on both the valuation and liquidity of Irish banks, but there was no change in regulatory approach. This was a form of regulatory capture, whereby regulators act in ways that benefit the interests of the institutions that they're meant to be regulating. On top of subpar regulatory oversight and extremely reckless lending by the banks, there was also genuine illegal activity going on behind the scenes. The so-called Anglo trials highlighted the true nature of business practices at Anglo Irish Bank. Internal phone conversations revealed instances of key bank personnel mocking and deceiving the regulator about how much money was required to save the bank. Anglo's CEO, David Drum, was sentenced to 6 years in prison for his role in orchestrating a €7.2 billion fraud. Drum only served 2 years and 8 months of that sentence. Sean Fitzpatrick, Anglo's chairman and ex-CEO, was on trial for artificially reducing the value of his personal loans from Anglo by €87 million in the bank's financial statements. Fitzpatrick wasn't convicted, largely due to the poor handling of the case by the ODCE investigator Kevin O'Connell. However, Anglo's auditor, Ernst & Young, recently received a €50 million fine for failing to identify the transactions. These are the people who were entrusted with keeping Ireland's banking system safe and sound. And that is the dark dark reality of the '08 Irish banking crisis.